Good
Morning.
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 Thank you very much for doing this. New face for AVI Japan, but I'll let you introduce yourself and tell us a bit about the fund, please.
Sure. So thank you for having me, first of all. I have been brought on to help sort of bolster the Japan investment team, which is currently about 8 people. I have been doing Japanese equities my entire career. Before I joined AVI, I was at Red Wheel working on their Japanese engagement strategy there. And before that, I was at Mizuho Securities and also Goldman Sachs in Japan, working out in Tokyo. And in terms of the AVI Japanese Opportunity Trust, I thought, James, it might be worth sort of taking a step back a little bit and sort of giving a bit of background as to why AVI even has a Japanese dedicated strategy. I think a lot of people will be familiar with AVI's global strategy, the Global Opportunities Trust, which used to be called the British Empire Trust, which has been going for 40 years. And within that trust, there was always quite a heavy Japan allocation. And the reason for that is those who know AVI will know the types of companies or the types of opportunities that AVI looks for are to really try and find undervalued, mispriced opportunities in the market. So typically, they will look at areas of the market that they consider undercovered or very badly covered, where they try to find companies that are trading at discounts and also that can be overcapitalized. And Japan, with the 4,000 listed companies that they have, is quite a rich hunting ground for those sorts of companies. In 2014 and 2015, so we're going back 10 years now, the infamous third arrow of Prime Minister Abe was introduced. So anyone who's been following Japan at all will have heard a lot about corporate governance reform over the past 2 or 3 years, but that really started over 10 years ago. And at that time, AVI decided to incubate a Japan-dedicated strategy, which worked very well, and launched it in 2018 as the AVI Japan Opportunity Trust. And why did they decide to do that? Well, people have been investing in Japan for a long time. A lot of people have been frustrated by Japan because even though there are these companies that on the face of it look really attractive, lots of cash on the balance sheet, trading at discounted valuations, and a lot of the time they're quite decent quality businesses as well, Japan became the infamous value trap of global markets. So what was missing was really a catalyst to change that. And Abe's introduction in 2014 and 2015 of the corporate governance codes and the stewardship codes were really the first iteration of this catalyst, which has actually been going on now for 10 years. So I think you're in charge of driving with the slides, aren't you? If I could take you for, okay, great. So this is the team. As I mentioned, there's 8 of us. It is a pretty much bilingual team across the board. And what is interesting is that our team doesn't come from typical sort of investment analyst backgrounds. We have management consultants, ex-McKinsey and ex-Bain, and we have myself from investment banking. And we really tried to build out this bilingual, bicultural type of team, which is very important for reasons I'll touch on in a little bit. So what's been happening in Japan, as you know, is that people have been focused on this corporate governance reform. So if you can go forward one more. Thank you. And people are thinking, okay, maybe things are now changing in Japan. And we would very much agree with that. There are a lot of opportunities for the kinds of investors who are really willing to do the work. It is a really unique opportunity. And I would say, having done Japan for over 20 years now, this is really like a once in a career, a once in a generation opportunity that structural reform is coming through. And there is a reason also that you may have seen a lot of headlines out there about private equity all over Japan. So they've been building out their offices and building out a presence in Japan for the past 5 to 10 years. But they too were waiting for a catalyst. And now it is the second most active market in the world in terms of corporate activity, because this sort of opportunity set doesn't really exist anywhere else. What kind of market do you have elsewhere which has 4,000 listed companies, half of which are trading below 1x price to book? You've got about 1,000 to 1,500 companies which have more than 30% of their market cap in cash. And again, for those who are willing to do the work, it is a really unknown and undercovered market. About 60% of the market has less than one analyst covering them. So this was the opportunity set that AVI realized was there. And they recognized that this would be an opportunity that we probably won't see again. And that's why we decided to set up and launch the Japan Dedicated Strategy 7 years ago. If you could go down one, please. Sorry. Thank you. So just to reiterate, this is what we look for in terms of companies, right? Under-researched, as I mentioned, there's a plethora of opportunities there, about 60% of the market. In terms of cash being structurally discounted, what that refers to is that, yes, there's half the market trading below 1x price to book. And part of the reason for that is, again, historical. There have been so many attempts at trying to unlock that shareholder value, trying to improve capital allocation amongst Japanese companies, which have really come to nothing. But now, with this changing environment, those assets, the cash assets and the non-core assets, which have been sitting on balance sheets with their valuations sort of being diminished to nearly nothing, they are starting to be valued, and they are starting to raise the valuations of these companies. And that is really something that attracts us and something that we try to work with companies to realize. As I mentioned, regulatory tailwinds. So yes, this started a decade ago with Prime Minister Abe. But what we have seen is, I think, something quite extraordinary, which is an amazingly coordinated and orchestrated effort by a number of different entities in Japan. So you have the government, you have the Bank of Japan, you have the Tokyo Stock Exchange, and you have the largest asset owners in Japan as well. So, for example, the GPIF. All of them have embraced the corporate governance codes and the stewardship codes and are really pushing from all directions onto these Japanese companies to try to get them to change. Very recently as well, METI, which is the Ministry for Economy, Trade and Infrastructure, they've put forward guidelines to try and educate companies on how they should deal with takeover bids and management buyouts. So again, this really feeds into this burgeoning private equity industry that we're seeing in Japan as well. Sorry, can we go back to the other slide? Richard, number 4 is really important. And again, having done this for a long time, I think this is the change that I've really seen on the ground with these companies. Because it is one thing to have an investor say to you, I've owned your shares for 6 months. I want you to give me back all the cash on the balance sheet. And to put up walls to that investor and say, actually, we don't even want to have discussion with you. But what has changed now is that a lot of these companies realize that they need to change. So it is not that you're pushing on a closed door. A lot of the companies are actually willing to speak to their shareholders and understand what it is that's important to them. And in terms of engagement, this is really linked to that previous point. When you come in as a company, so when you come in as an investor and you talk to a company, it's pretty boring if you go in there and you say, actually, can you please just give us the cash back? Because that's what everyone says. And what we try to do at AVI is really look at it from the company's perspective. When we're meeting the executive management team, we're thinking, okay, what is it that keeps you up at night? What is it that you want to achieve over the next 5-10 years of this company? And more often than not, again, they understand that pressure that they're under. They want to improve their valuations. They want to improve their margins. They want to improve their profile amongst shareholders, but a lot of them don't know how. And we will go in, and again, this is where the management consulting background of our analysts is really important. we will go in there with a 70, 80-page presentation when we first meet the company. And we'll say, we've done all of this work on your company, and your company is amazing at doing X, Y, and Z. But if you want to improve your company operationally, if you want to improve your margins, these are the guidelines we can give you to do that, and we can help you do that. And then secondly, we also look, of course, at capital allocation. But what we're really trying to figure out is, what does the company want to work with us on? And I think that's a big differentiating point between us and some of the other activists out there. Sorry, Kigo. Thank you. One thing is that we focus on mainly small mid-cap Japan. And why is that? Well, again, to repeat, the sorts of companies that we look for, under-researched, that's mainly in small cap Japan. Everyone covers Toyota and Hitachi and SoftBank. You're not going to find a lot of sort of hidden value or hidden gems within that portion of the market. Very importantly, they're also deeply discounted. Small cap Japan, as I mentioned, trades very cheaply, especially compared to their larger peers. And there's a lot to work with them on. So there's a lot more margin where we can really influence what the company is doing and how that impacts the valuations of the company. As an example, the Tokyo Stock Exchange recently has put together a now infamous name and shame list, where they've taken the companies and they've said, okay, what we want from you is, we want you to show us that you think about capital allocation and working capital. We want you to understand what your valuations are, and if they are below 1x price to book, we want you to show us that you are taking steps to amend that and to raise your valuations. And one other thing that they've come up with as well is, you need to disclose clearer information about your company, and you need to do it at the same time in English and Japanese, because otherwise foreign investors have no idea what you're doing. So within the small cap Japan, they are cheaper, they're less known, and there's a lot more to work with them on in terms of engagement. Thank you. One other point about the small caps, which is sort of relevant at this point in time, is that historically small cap Japan has outperformed the large caps until 2 years ago. And what happened 2 years ago is that the yen experienced a massive devaluation, so over 30%. And what that did in turn is, of course, stimulate the earnings of the exporters and the large cap exporters specifically. So you had, over the past 2 years, a huge gap that has grown between large cap and small cap Japan. You're talking 27% outperformance by the core 30 names in Japan over small cap, which has been entirely driven by the weak yen. But what we know now, of course, is the Bank of Japan is looking to normalize their monetary policy. They are very aware of the issues that come from having a weak yen in terms of imported inflation, not just for companies, but also for the consumer. And so what we can expect to happen is, gradually over time, that the yen will likely start to strengthen again. And that could bring about a reversal in this massive outperformance that we've seen with the large caps. Next, please. This is just a timeline. Again, I sort of touched on this already, but just to reiterate the fact that all of these changes that we're seeing now have been a long time coming and have been in the works for over 10 years. So it's definitely not a flash in the pan situation. Yeah, so these are some metrics just to show you that things really are changing. Buybacks are at a historical high, and that will continue. I saw something really interesting today, which said that for the first time in decades, that share buybacks in Japan are having more impact on the market than foreigner flows, which is incredibly encouraging. It means that, the Japanese companies are buying back their own market, and that's a very healthy sign for the market as a whole. Cross-shareholding, which is a very Japan-specific phenomena, where, they effectively act like poison pills. You own shares in your affiliate companies, in some of your suppliers and the supply chain, etc. And again, the Tokyo Stock Exchange has said that they are taking a very negative view of companies that have cross-shareholdings for no reason. So we've seen a decline in that. On the top left, I wanted to highlight that, yes, that chart looks impressive in terms of number of shareholder proposals. However, again, 4,000 companies and only 113 shareholder proposals. That means there is still a long way to go. We do get asked, do we think the move has happened? And absolutely not. I think we are still very much in the beginning. This is just to highlight what the portfolio looks like. As I mentioned, small mid-cap focus, because that's where we see the most attractive opportunity set. And I think in terms of the industry breakdown, this is really an output rather than an input. We're not macro, we don't look at things top down, but it just shows that we are able to have a very diversified and accessible portfolio, even though we're focusing on the small mid-cap market. This is something to highlight in terms of how we do engagement. So I think we sit in a really sweet spot in the middle. We consider ourselves constructive activists, so the vast majority of our engagement is done behind closed doors. We will meet with companies 300 times a year. That's how many company meetings we do. I just got back from Tokyo last night, having done, I think we've done 50 meetings or something over the past couple of weeks. We are very intensive with our engagement. We are very full on. We take a lot of time to get to know the companies, a lot of time to understand the challenges and the blocks to increasing corporate value. And then we spend a lot of time working with that management in a very intensive way to try and realize that, value creation. There are times when we will have to push a little harder. And there are times, you can see it's a handful of times only over the 7 years of the life of the fund, where we will go public, where we feel like we have, reached an impasse with the company, and we will take things a little bit more public. But for the vast majority of our engagement and our companies, we do things in a private way, private engagement. And what do we engage on? As I mentioned, operational improvements, capital structure. We still have a fortune basically sitting on corporate balance sheets around Japan, not just in cash, but in investment securities, cross shareholdings, and real estate assets. So this is the portfolio performance in yen. And the only reason I'm bringing this up is because, as I mentioned, we've seen a 30% devaluation in yen, which has eroded the performance of the fund in sterling terms. However, if we are to see a reversal in that trend, then that could work the other way and actually be a tailwind for sterling returns for the strategy. We have a highly concentrated portfolio. We build large stakes in our companies to ensure more effective engagement. The top 10 make up about 70% of the portfolio. And as I said, we do a huge number of company meetings. And it's not just with senior management. It's also, as I mentioned, with non-executive directors. We will meet with employees. We will meet with previous employees. We really try to get a very detailed and holistic picture of the companies that we're engaging with. And therefore, what are the issues and how do we pull the levers to make a more impactful engagement with these companies? In terms of pipeline, we are finding ever more opportunities, partly because companies are feeling much more that they want to speak with us, that they want to change, that they want to have their hand held in terms of increasing their valuations. And that has really expanded the pool of companies which we are able to engage with, who we say are engageable. And we've already had 3 new additions into the portfolio this year. 2 of them actually in the logistics space, which has been a really interesting part of the market for us to work with. Richard, I didn't know if you wanted me to go through a couple of case studies, but one thing I wanted to mention before we do that is I said at the very beginning about private equity in Japan. What has been really interesting is that we've seen that increased activity in a very real way within our portfolio. So last year, bearing in mind we only have like 22, 23 companies, 4 of our companies were taken out last year. And it's not an exit we look for necessarily, But as I mentioned, private equity are sitting there looking for just the sort of companies that AVI like to look at as well. And so it's quite, it's been incredibly powerful for us to have them sitting on the sidelines and know that they're at least active in the market now.
That's great. And it would be cool to talk about some of these holdings. But before we do that, we've got some questions coming through already. So let's maybe step back a bit. So interesting one, I thought. How do you feel the process, the experience of being an investment manager in Japan differs from being an investment manager in the UK, for example?
I think transparency is a big one. As I mentioned, sometimes the act of getting information is a lot more laborious and a lot more intensive than I expect. I mean, I've never been an investment manager anywhere else, but than I expect it would be in the UK, for example. You have a language barrier. You have B, an information barrier. This is why the Tokyo Stock Exchange is really pushing these companies, because, a lot of the disclosures are almost meaningless. So they're really trying to make them more sophisticated and get them to understand what it is that the investors need to know about their company to be able to assess them properly. I think not so much now, as I mentioned, but certainly when I first started doing Japan, it could be a very opaque market, quite difficult to get to know company management. I mean, there were many times when company management, they just refused to see investors. They was like, nope, they want to see them. And so how are you supposed to really value and assess a company if you don't have access to that company? Another thing that I think is quite interesting, and this is a very sort of real example because it was reflected in our portfolio recently. So non-core assets. So yes, okay, cash, you can see how much cash there is, investment securities, that's pretty easy to work out. But what about real estate? If they've had real estate on their books for 30 years, 50, I mean, some of these companies are 100 and something years old, right? How do you value that real estate if they're just valuing it at the price they paid for it, 50 years ago? And so for where we think that there's a clear discrepancy between what the assets are worth and what they're being reported at, we will actually get a third-party appraisal done on those assets. And TSI, which is one of our largest companies, largest holdings, that really came through earlier this year. So they're an e-commerce operator, and we felt that their financial value was 175% of their market cap, partly to do with real estate holdings. And they had an old headquarter building in Ginza, which is, I suppose, the equivalent of Mayfair in London, or Fifth Avenue in Manhattan. And again, it was valued at next to nothing. So we then got a third-party appraiser in. They valued it at about 3 times more than what the company did. But actually, they sold it. And again, of course, we've been engaging hard on this topic, right? They sold it in January, and the price was even higher than the appraisal value we had for it. And it ended up being a third of their market cap. And that's just one building. These, again, for those who do the work, and I think that is probably a big difference, is like, do those issues exist when you're investing in the UK? I don't know. Exactly. So I think it's that you have to really go, I think, above and beyond sometimes to accurately value these companies.
There's a question here about the risk that I see in small caps, but actually I'll slightly twist that. How do you avoid getting stuck into small companies that actually have real problems? And that's one of the reasons that they're cheap.
So I think that's a lesson learned for a lot of people who've been investing in Japan. In the past, as I mentioned, it got a really notorious reputation for being value trap for exactly that reason. You could pile into a company and think, oh, great, of course they're going to give us some of the cash back, or, spin off this non-core business or whatever it is, and nothing would happen. So the way that we try to negate that or minimize the risk of that is that we do not invest in rubbish companies. So we have to have some measure of quality in that business. It has to be profitable. It has to generate cash. It has to have a strong market share in whatever niche product or service or widget that they produce. The idea being that even if, and luckily this hasn't really happened, but even if, let's say, engagement is total dead end and totally unsuccessful, that underlying business is still chugging along quite well. Now, we try to minimize the chances of us, having zero impact with our engagement by getting to know the company really well beforehand and testing them out to make sure that they are engageable and they actually do have an opening for us to come in and speak to them constructively. But from a fundamental perspective, the way we try and minimize that is to focus on companies where there at least is a decent underlying business.
Then you talk about TSI, that 175% of its market cap assets is meat, effectively. How is it possible that these things, that nobody else can spot this? How are you identifying these things that?
So no one else spots it, but I think the process to narrow down that market of 4,000 companies to this portfolio of 20 something, it's quite a sort of what's the word? It's quite a detailed process, and as I mentioned before, even thinking about taking a position in a company, especially because we take big positions. If one goes totally belly up, then that's a serious problem, right? So we have to do a lot of due diligence before. Are there other investment managers willing to do that? Go that step further. Do they have the resources? Do they have the language? Do they have the access to management? Do they have the ability to go to Japan or be in Japan and have that many company meetings and get to know the companies that well? So I think, yes, perhaps other people could do it, but it's whether they are willing to.
Yeah, exactly. To what extent do you think about the top down? So there's two elements to that. So there's the sort of macroeconomic thing of where interest rates are going, how strong the yen is, I suppose, from tariffs and that sort of thing. How much of that are you looking at when you're deciding what to invest in?
So the stock answer is we're fundamental bottom-up stock pickers, which we are. The reality is, of course, you have to be aware of what is going on, especially in terms of, for example, now with Trump. I think what is changing in Japan is changing so significantly, coming out of zero interest rate policies, the fact that, as I said, you have this big coordinated effort by all these entities, including the Bank of Japan, to really get the stock market going. In terms of what's going on with Trump and tariffs, yes, that's probably going to be, really bad news for a lot of large cap exporters, which have been enjoying the weekend for the past 2 years. But how we look at it is, we would probably never invest in a company that had their operating profits swung so largely by an external factor that we can't control anyway. So whether that be the yen or interest rates or commodity pricing, when you are an engagement strategy or you're an activist, to invest in a company where no matter what you do in terms of engagement, that external factor is going to have a much larger impact on profits, then that becomes a risk that you probably don't want to take on in terms of your investment.
The other aspect of that is looking at sectors. And you can sort of see that you're not looking for growth sectors and things. When you've got things like Hatsugi in there, it's a textile company. It's that sort of most old-fashioned you can get. I mean, is there any kind of sense of thinking, actually, e-commerce is growing really well, so let's go after something like Beano's?
Yeah, I mean, no, it starts off on the premise that I mentioned at the very beginning. Are they valued cheaply? Are they overcapitalized? Are they unknown? And do they have some quality characteristics of them as well. So that is what we start with. And if, e-commerce pops out of that, great. If it's a textile company, okay. It's, we are very cognizant that we wouldn't want to have, half of the portfolio in a certain sector. But equally, if there is a lot of interesting companies in one part of the market, then why not look at that? So, for example, we had a really successful story with a logistics company last year called Alps Logistics. It was a parent-child subsidiary situation. It was taken over at a big premium. And that is because it's a very fragmented industry with a lot of very asset-rich small companies within it. And a lot of these relationships between parent-child subsidiaries, cross-shareholdings. So there's a lot of potential there to make that part of the market more efficient. And we have found, 2 new companies for the portfolio, both of which happen to be in the logistics area. So that is somewhat informed by external factors in terms of what's going on in that sector, particularly. But yes, I think the answer is you have to be aware of what's going on, and you have to be aware of the risks inherent with what's happening outside of, the world of Japanese small cap equities. But that is, of course, part of the investment process as well.
I've got the Alps Logistics sign up here, but it's interesting that it's private equity. Why are private equity funds starting to invest in Japan now when they weren't before?
So it seems like they've all sort of come out of nowhere, but they have been there for, especially the big global players. I'd say about 5 years ago, I started hearing that they were setting up offices, they were hiring people. So in a similar way, right, we started our strategy really, 10 years ago, when we started thinking about, okay, we're going to lay a foundation to invest actively and in a dedicated way in Japan. They probably saw the same signs as well, right? And they have been allocating more and more dry powder to Japan. And as I said before, where else in the world do you have this kind of opportunity set for private equity? It must be really fun to be private equity in Japan at the moment, in the same way it's really fun for us to be trying to find these companies, because there's just so much opportunity there. And I think what's also really encouraging is it's not just the big global players like KKR, Apollo, whoever. There's a really healthy domestic private equity industry that started up, and they are focused very much on the small cap market where we are. And that's been great as well, because, as someone who's Japanese or half Japanese, I'm like, I want Japanese investors to reap the benefits as well of what's going on in Japan.
Yeah, fair enough. Obviously with this, you get a big, fantastic premium. That's an obvious sign to exit. But otherwise, if you've got something where you engage with it and you think you're going to, what makes you decide to sell something?
Well, it'll be a number of things. The ideal situation is that, of course, we've reached what we consider fair value in the company. When we go into these companies with these very large presentations, as I mentioned, it's a very clear roadmap of not just what we want to work with the company on, but what the timeline is. And if we feel that we have reached the end of that timeline and we've actually achieved what we want to achieve, that's the best reason to exit. It could be, for example, we had a company recently who we got out of because they had originally, when we first invested with them, had a lot of cash on the balance sheet and a lot of work to do in terms of shareholder communication. Their shareholder communication didn't really get any better, and they ended up using a lot of the cash on the balance sheet for what we thought were not very additive reasons there in terms of their capex, in terms of M&A, etc. And so, yes, exactly. So if you look, net cash was 22% of market cap, and it went down to 7%. The valuations went up quite significantly. I mean, we made a decent return on it, but we felt that, the cash could be better deployed elsewhere. There are so many other exciting opportunities out there.
Yeah, that's fair enough. And then there's a question here about buybacks, but actually I think that's something else. So the other thing that you've seen is a lot more dividends.
Yes, dividends and buybacks. If I can take you to where are we? Page 17, please. I know that the takeover bids and private equity gets a lot of airtime because, it's all very exciting and, big premiums, and isn't that wonderful? But I think, 17. Okay.
There we go. Hey.
Oh, hang on. You've got a different one than me. Okay. Oh, can you go back up one? So it's probably 16 on yours. Thank you. I think what's really encouraging that it's not, yes, TOBs are exciting, but what's been happening is that we are seeing a really regular and impressive commitment by companies to increase dividends and also to do buybacks. So we had 6 companies, I think last quarter, in the past year, who've done significant buybacks, for example. Part of what we engage on is really around having companies commit to a dividend policy. Otherwise, it's a bit finger in the air. We don't really know what they're going to be doing. So that's something that we work on with the companies as well. And yes, we've been having a lot of success with that. I think as a market as a whole, Japan's total shareholder return now is at historical highs if you take buybacks and dividend increases into consideration.
Great. But still cheap. Exactly. Good. All right, then. I think we covered a lot around here. I'm just trying to think if there's any questions we haven't actually addressed here.
Yeah, sorry. As I said, I got back last night, so I'm super over-caffeinated and probably spoke at 100 miles an hour. But yes.
But the risks, can you see any risks going forward?
For Japan as a whole, you mean?
Well, but strategy, actually.
So what I really liked about the strategy when I was looking at it and deciding, to come and join AVI is that the process is so solid, and because you have that underlying quality characteristics of these companies, the portfolio doesn't get swung around as much as a lot of other types of strategies by things that are happening outside. So when the strategy has had negative performance, for example, it hasn't been like a massive drawdown like you've seen in other strategies. It's a very resilient portfolio. I think, so in terms of single stocks and single portfolio companies, as long as we keep doing what we're doing and we understand the companies really well and we're working with them in a very intensive way, then I feel pretty confident. I think it's more what's happening outside of Japan, to go back to your point about macro and how people feel about Japan as a market that might inform, especially the larger cap area of Japan. I think there's just so much volatility at the moment and so much uncertainty with what's going on with Trump and tariffs. It is. I would definitely be concerned if we were focusing more on that part of the market, but where we are, we're relatively insulated by what's happening. So, the hope is we just keep doing what we're doing. The companies keep working towards increasing their valuations. Are happy to work with us.
Yeah, exactly. This is what I was thinking. It's kind of like a self-help story.
Absolutely, that's exactly what it is. It's self-help, and we're like the therapists helping them get there.
Brilliant. Thank you very much, Nicola. That was really good.
Pleasure.
And we covered a lot of ground. We'll get you back on again in a year or so and see how it's all been going. But hopefully another year of the same.
Yeah, well, thank you very much for your time again.
So we'll be back next week, and we've got the CEO of the AIC on, so Richard Stone. So plenty to talk about there. There's obviously a lot going on with the industry, and that should be quite interesting. So I see you next week. Have a good weekend. In the meantime, bye.